here at ChrisCapri2ndsGuysForex.com. So this is part one of a two-part series we're doing today. This video that we're doing today, the first part here, is going to be on price action trading, particularly relating to volatility. The markets have been incredibly volatile as of lately. We can see just by this huge candle here on the pound yen here, this one candle is about 1,200 pips from top to bottom. It's incredibly volatile. The market snaps back, and so I have this feeling, I've been getting a lot of comments and emails from traders in the courses and things like that. I have this feeling based on all these comments and what I'm seeing in the markets is that the retail traders have been getting pretty hammered by this here. Maybe you're on the wrong side of the market and you didn't have a stop in place. You could have gotten wiped out from something as simple as one of these little candles here. Or their stops got kicked because the market was just too volatile and they didn't get filled till much later, or they were leveraging way too much. Before we actually get into the trading technique, this stresses the importance of having proper risk management techniques. If you want to trade like a professional and do this for a living and make money just off of trading, you have to do what professional traders do. They do not have 10 or 20% risk in one particular trade, probably more like around 2%. They don't have trades with no stops in place. They have stops in place. So this is something that you're going to have to do to avoid getting hammered. If you're caught in the wrong direction, on any other normal day, it's not that big a deal, but on this day, with this giant red candle, it's a much bigger deal. It changes the game completely. One little thing like this could wipe out, an entire account if you have improper management or risk management and no stops in place. So how do you avoid doing this here? How do you avoid, getting caught with taking these big hits here? Trading volatility should actually, in some sense, from a money management standpoint, be no different than when you're trading any other day. You have your stops in place, you have a fixed amount of risk, 2%, 5%, doesn't matter, so that if you get stopped out, it's no big deal. It's just like any other day. It's just like a loss on any other day. However, there are ways for us to take advantage of these opportunities because they do present trading opportunities, and we can use just a simple price action technique to do this. So now we've covered the risk management aspect, have your stops in place, have a small amount of equity at risk to avoid taking the big hits. Now how can we take advantage of this? Well, volatility in the markets are very much like a rubber band. If you hold a rubber band with your two hands and you pull it with one hand there, if you pull it a little bit, when you let it go and snap back, it will snap back a little bit. But if you pull it a lot, pull it really far apart, when it snaps back, it's going to snap back really hard. That's very much how the markets work. Currency markets will overshoot. And so using Fibonacci's, for pullbacks or something like that may not work. However, you want to use something that kind of is a good gauge of equilibrium for the market when the market is going to pull back, and that's the 20 EMA. I generally recommend using it on the daily or the 4-hour time frames. So you can use it on the 1-hour time frames, but it won't hold as long as it will on the 4-hour dailies. So here we have this huge sell-off here on the pound yen, and it snapped back within a hair's breadth of the 20 EMA, kind of curved with it, and then went down. Here, a little more pronounced example is the euro yen. Take a look at this one here. Thing sells off in 3 candles from 125 to 110, 1,500 pips, and then from 111 here, shoots back 1,100 pips. Where does it stop dead in its tracks? The 20 EMA, before it continues going on back where it originally gone to. So when the market is really volatile, the market will often snap back to a place of equilibrium, and that often is the 20 EMA. Then it usually continues on in the same direction. If the selling was legitimate, then it should return back to those same prices. The only difference is it got accentuated or amplified by the fact that there's more volatility. Once the market caught its bearings again and came back to equilibrium, it started selling off at a more corrective measured pace. Same thing here. Take a look at the dollar CAD. Market had a huge spike in it here, and then look where it snaps back to and stops dead in its tracks. 20 EMA. We had a little bit of price action below it, but they were all rejections. Nothing was able to close above it here, and then it continued on doing what it was doing before. So that's a very simple technique on how to do it. The key here is not to trade breakouts, and the reason being is that you could be trading breakouts, but then you could get caught in the crossfire. You can get caught in that snapback. Maybe you took a breakout of these lows over here, and within a day's time frame, you're like, wow, I'm up a few hundred pips. And at the end of the day, when it closed, you're barely down, or you're barely up 50 pips, and you're sitting there going, oh, well, I was already up 400. It should go right back down. And look what happens. It swings back negative in the other direction. So, I mean, you could have wider stops, but then you have to reduce your position size so that you're risking the same amount. And so instead of having wider stops, just take a simple pullback to the 20 EMA on the daily or the 4-hour time frames. Very, very simple technique. All those pairs would have worked really well. Now let's take a look at, on a smaller time frame, after the market stabilized, how did it respond to the 20 EMA here? Here's the snapback, and then the market kind of normalizes around the 20 EMA. Look where it's spending more time, below it or above it. It's spending more time below it and deeper probes below it than it is above it. And look what happens. We have another sharp sell-off with a little corrective pullback to 20 EMA. Stops dead in its tracks, sells off 400 pips, corrective pullback where to? 20 EMA. And so it's a very, very simple technique. Let's take a look at a couple other examples here. You can see it on the pound dollar. It's a very similar thing here. Once it normalized, sold off, comes just shy of the 20 EMA, but then it gives you a second chance here. Boom. And then sells off again. So this is a very, very simple technique. Instead of trading the breaks on these things, you could get caught in the snapback. You could get caught in all that volatility. So just wait for a pullback. Look for a pullback to a 20 EMA on the daily or 4-hour time frame, and then use those little opportunities to get into the market and re-enter in the direction as the original sell-off and where the volatility took it. Remember, the direction was legitimate. It just got accentuated by the fact that the volatility was a little bit higher in that time. So this is a very simple technique, a very simple price action technique. If you'd like to learn more advanced rule-based techniques, get some mentoring, get some trade signals, and get to join a forum and a community of traders, then check out my price action course or any of our courses there. In fact, if you'd like to find out how to get a discount on it, just email me info@secondskies.com. So this is part 1 of a part 2 video series. The next one coming out is on central bank intervention and what does that look like and how we can trade that. And so stay tuned for the next video. Until then, good luck trading.